Welcome to Wealth Lab. Today, we're breaking down the truly surprising, totally unintuitive math behind making small, consistent investments over time. We're skipping the heavy financial jargon and diving straight into what actually happens when you put your money on autopilot.
But before we look at the actual numbers, I want you to play along for a second. Take a guess at what investing just $100 a month turns into after 10 years and then after 20 years. Seriously, lock a number in your head right now. I'm asking you this because our human brains drastically underestimate exponential growth. We tend to think in straight lines, but compound interest? That's a curve that bends straight up.
Section 1. The power of small amounts. Overcoming the boring beginnings. We're going to start by looking at why people so often dismiss small investments, like $100, as pointless, and why falling for that psychological trap is incredibly costly.
Okay, here's the part literally nobody talks about. You set up your automatic transfer. You're feeling great. In the first 6 months, you contribute $600. But then, the market has a bad week, and suddenly your balance sits at $578. Your money is barely growing, and market fluctuations might even leave you with less than you put in. It feels incredibly unrewarding, right? It's definitely not a number that's going to impress anyone at a dinner party.
So this brings us to a crucial point. The gap between knowing and continuing is where most people exit. When you're staring at $578 after 6 months of hard discipline, it is so easy to just stop. Getting past this boring, invisible initial phase without quitting is absolutely the hardest hurdle you'll face. But you know what? It's exactly what separates successful investors from everyone else.
What's really cool is what you actually achieved in that first year. Your true victory isn't some tiny market return. The real victory is discovering that your life didn't fall apart without that $100. You proved the money wasn't load-bearing for your budget. You built a permanent habit. You literally shifted your identity from someone who says, "I can't afford to invest," to someone who builds wealth.
Section 2. The real numbers, when the machine takes over. Let's look at the hard arithmetic to see exactly what realistic growth looks like at decades 1, 2, and 3, using average historical market returns.
All right, after 10 years of consistent investing at a realistic 7% average return, the $12,000 you contributed has quietly turned into over $17,300. That's over $5,000 of pure growth. The math is starting to wake up. Your money actually has a job now, and the returns are slowly starting to match your own contributions.
But just watch what happens next. By year 20, the math accelerates wildly. At a 10% historical average, your balance hits roughly $76,000. Think about that. You've deposited just $24,000 of your own money, which means the machine has given you $52,000 of compound growth. The gap between what you put in and what you have is now more than double your total investment. The machine is doing the heavy lifting for you.
And here is the 40-year number. If you maintain this $100 habit for 40 years at that 10% historical average, the machine generates over $637,000. You only ever contributed $48,000. That means over $500,000 grew simply because you didn't stop. You never had to work an extra shift for it. It grew entirely in the background. Crazy, right? Vanguard data brilliantly illustrates the massive difference between waiting and acting. Tracking a real 30-year period, there's a stark contrast between an investor who drops in a $1,000 lump sum and does nothing versus someone who continuously adds a small $100 amount of financial fertilizer every month. The difference is astronomical, $14,000 versus $176,000. Consistency is absolutely the magic ingredient here.
Section 3. What changes the outcome? Time and consistency beat the amount. Let's explore why your starting age and your unwavering consistency actually matter far more than the actual dollar amount you're contributing.
We all know someone who is waiting for the perfect time to invest. The person who waits for a large windfall or a bigger paycheck to start investing $1,000 a month almost always loses out to the person who starts with a boring $100 today. Why? Because time is the one asset you simply cannot replace.
And part of why starting right now works so well is a concept called dollar cost averaging. By setting a strict schedule to invest your $100, you remove all the emotion. When the market is booming, you buy shares. When the market drops, well, you naturally buy more shares at a discount.
Data from Russell Investments shows exactly how this works in practice. Because you're investing the exact same dollar amount every single month, you automatically buy fewer shares when prices are high and more shares when prices are low.
This mathematically lowers your average cost per share over time during volatile market swings. You don't need to predict the market at all. You just need to participate in it consistently.
As the data proves, time beats money. If you look at 10-year balances, simply starting 5 years earlier builds drastically more wealth than dramatically increasing your monthly contribution amount later on. Time doesn't wait for the right amount. It runs on whatever you give it.
Section 4. How to start. Automating your $100 starting this week. So how do we actually put this into practice? The best part is you don't need a financial advisor or a high income to do this. If you're finding this valuable, please subscribe to Wealth Lab and share this video with your friends and family. It really helps us grow. This is the entire straightforward roadmap right here. First, open a brokerage account with a reputable firm. Second, select a broad, low-cost index fund that tracks the whole market. And third, and this is by far the most crucial step, set up an automatic transfer so you never have to think about it again. When you pick that fund, make absolutely sure you select an index fund with minimal fees. You want to look for expense ratios under 0.04%, like FSKAX, VTSAX, or SWTSX. This matters so much because expensive, actively managed mutual funds can quietly drain thousands of dollars from your long-term growth.
In fact, financial reports highlight that ignoring trading fees or the costs of administrative platforms is the surest way to lose buckets of money. Ignoring those tiny fractional percentage fees is the easiest way to give away wealth that should belong to you. Keep it simple and keep it cheap.
Once you have the fund, automate it. Automation beats willpower every time. By setting the transfer to happen automatically on payday, you completely remove human emotion. You guarantee that the schedule never negotiates with market conditions, bad news, or a sudden urge to buy something you really don't need. The decision is already made.
The compounding machine runs on whatever time you give it. It doesn't care about your intentions, only your actions. So consider this. Where would you be today if you had started just 5 years ago? Thank you for joining us today. If you haven't already, don't forget to subscribe to Wealth Lab. We'll see you in the next one.